Welcome to the deep dive. Today, we're strapping in to examine a company that is, well, foundational to the entire global auto industry. But it's also a company that's fighting what might be the biggest identity crisis in its six-decade history. We're talking about Aisin.
hmm
And for anyone who might not know the name, this is an undisputed heavyweight. We're talking about the seventh largest auto parts manufacturer in the world as of 2024. A massive enterprise, something like 114,000 employees globally.
And that scale is exactly why this is so critical. For decades, Aisin defined itself by, the philosophy of Monozukuri, this idea of flawless, heavy, comprehensive manufacturing.
Right, the art of making things.
Exactly. But the future of mobility demands something different. It's all about electrification, software they have to transform into a moving value provider, or kodozukuri. It's a total philosophical shift.
A completely different way of thinking.
It is. And the core question for you, listening, is whether this massive corporate pivot can actually navigate the extremely volatile future of mobility and deliver real growth over the next 3 to 5 years.
So our mission today is to unpack that. We want to go beyond the headlines and find the strategic decisions, the legacy businesses that are surprisingly resilient, and even some counterintuitive innovations that are really driving Aisin's future.
Okay, so let's start by just mapping the sheer size of this company.
Right.
Its roots go back to 1965, a merger of two companies, Aichi Kogyo and Shinkawa Kogyo.
Right.
And if you look at their revenue mix today, it tells you everything. Powertrain components are still the behemoth. We're talking almost 55% of total sales.
Yeah, that's the legacy right there. But the real structural strength, what makes Aisin different, isn't just the volume. It's the breadth.
What do you mean by that?
I mean, they're strong across a truly comprehensive range of vehicle parts, hydraulics, electronics, thermal control systems. If it goes into a modern car, chances are Aisin makes a version of it.
And they have their own test course, right? That seems unique.
It's a huge advantage. It lets them validate and tune complete integrated systems, not just, isolated parts. That system capability has to be a major asset, especially now that cars are basically integrated software platforms.
It is. But they're still dealing with the fallout from that huge reorganization back in 2021.
Which was all driven by the rapid shift to electrification and, of course, what was happening in China.
Exactly. And this is where management gives us this really fascinating, candid insight. They openly say that getting true synergy from that merger is still only at the 30% mark.
The 30% mark.
Yeah, in Japanese business, they call it 3A. It's like being at the third station on a 10-stage climb up Mount Fuji.
So they're saying they have a long way to go.
A very long way. The foundation is there, but they're just starting the real climb.
But wait, if they're only 30% integrated, that suggests the efficiency gains they need to fund all this future growth. They're still far off. Isn't there a risk they're trying to fund this pivot with a structurally inefficient organization?
That's the core tension, and management knows it. That's why they keep emphasizing this need for aggressive selection and concentration of resources. The structure is built. Now the surgery begins.
Okay, let's look at how that stabilization is going. Over the last couple of years, it's been all about recovery. Revenue grew from $3.5 trillion in 2021 to almost $4 trillion in 2022.
And the projections for 2024, early 2025, are estimating sales hitting almost $4.9 trillion. So the top line is strong.
And that's come with solid operating profit growth. But what's really driving that profit?
Well, this is what's so insightful. Yes, structural reforms help, managing capacity and so on.
Yeah.
But the company materials clearly cite a major external impact, the sustained weakness of the Japanese yen.
Ah, so the weak yen was basically a profit driver for them.
Not a deliberate one, but a highly beneficial one, yeah. It gave them this huge positive tailwind that helped offset all those rising global costs for materials, logistics, you name it.
So it's like free breathing room.
It's exactly that, breathing room they're using to fund this massive pivot.
Which brings us to their 3-year plan that started in 2023. The mantra is, change the substance of the business and gain strength.
And this isn't just passive budgeting. It's a radical internal reorganization of capital. They are aggressively shifting people, CapEx, and R&D spending into what they call growth regions.
And by growth regions, they mean e-mobility and advanced driver systems.
That's it. And you can see how serious they are in the metrics. They're targeting an aggressive capital expenditure ratio, 65% or more, going into those areas by 2025.
65%, and that's up from what, just 30% in 2021?
Exactly. It's a drastic shift.
And the R&D numbers are even more telling.
They are. They're aiming for 75% or more of R&D spending to go to those growth areas by 2025. Just a few years ago, that was 43%. It's a massive fast reallocation of their engineering talent and their research funds.
That is placing a huge, concentrated bet on their future. The goal is to grow sales from these new areas by 3 times between 2021 and 2030.
An ambitious goal, and one that has to be managed globally.
Right, because Aisin is a truly global player. Their 2023 sales were remarkably balanced. Japan was 24%, North America 22%, Asia was about 24%, and China at 17.5%. And China, in particular, seems like a critical region for them, but maybe not for the reason you'd think. They aren't betting everything on pure EVs there, are they?
No, and this is a key strategic nuance. They see China as a huge opportunity, specifically for plug-in hybrids, PHEVs, and regular hybrids, HEVs.
So the transitional tech.
Exactly. They think those hybrid solutions have the highest practical utility in China's move to carbon neutrality right now. And because Aisin has deep local production in China for those components, they're perfectly positioned to capture that demand while everyone else is, struggling with the cooling BEV market.
But when you operate at that scale, geopolitical risk, especially the U.S.-China conflict, is a constant operational factor.
It is, and they're monitoring everything from chip shortages to economic security.
Yeah.
The steps they're taking really show how critical this has become.
Like that internal alliance review board?
Yes. They created that specifically to evaluate economic security and legal risks before they even form new partnerships.
So it's preemptive due diligence.
It's massive,
Yeah.
especially for new tech and electrification and intelligence systems where IP is so sensitive. They're making sure they don't jeopardize their Western business by association. It's just part of the product lifecycle now.
Right. Let's get to the core of this. The hidden logic behind Aisin's transformation. It really seems to come down to this counterintuitive electrification strategy.
I'd say so. They are capitalizing on the chaos in the market. The slowdown in pure BEV adoption, combined with the booming growth of hybrids in places like Asia, it plays directly into their biggest strength.
Which is?
They're arguably the only major supplier offering a full lineup of electric units. HEV, PHEV, BEV, even fuel cell. They're betting on the entire mixed fleet, not just one winner.
And if they're betting on the whole mix, what's the single most important product in that strategy?
It's the eAxle, the integrated electric axle unit.
That's the centerpiece.
It is. And they're aggressively scaling capacity toward 4.5 million units. The deal with BMW is huge here.
The production partnership with BMW AG for eAxles in China and Europe?
That's not just a contract. It is a profound validation of their technology against the absolute best European engineering standards. It's a massive flag planted in the ground.
But here's what I find so smart about their transition. They aren't just throwing away their legacy. They're using their decades of expertise in complex automatic transmissions to expand their hybrid offerings.
Precisely. That legacy knowledge base is their cash cow. It lets them capture all that strong HEV demand right now and maintain share in shrinking, but still very profitable gasoline markets like India and South America.
They're using the old to fund the new.
Using their Monozukuri moat to fund the transition to Kodazukuri.
And electrification isn't just about the motor. You mentioned their regenerative cooperative brake system. Why should anyone care about a brake system in an EV?
Because it's a huge differentiator based on system efficiency. The value proposition is so concrete and compelling for car makers. Aisin's goal is to increase overall vehicle range by over 10% by 2025, just using this braking technology.
Okay, let's pause on that. 10%. Why is that such a game changer for a car manufacturer?
Think about the cost of an EV. The battery is the single most expensive component, easily 30, maybe 40% of the vehicle's total cost.
Right.
So if Aisin can reliably deliver a 10% increase in range by just being more efficient, by harvesting more energy back into the battery when you brake, it means the car maker can install a smaller, cheaper battery and still get the same advertised range.
So Aisin is offering a way for them to save potentially billions in battery costs.
Exactly. It makes their cars more competitive on price, on resources. That's not just a component sale, that's a competitive weapon.
And that system efficiency perfectly connects to their second big driver, right? This shift from thing-selling Monozukuri to value-providing Kodazukuri.
Yes, and this is where their history in car navigation becomes a brand new revenue source. They ship 4.6 million nav units a year. That creates a massive data-rich base for what they call mobility service platforms.
And we're seeing that in real-world applications, like Choisoko, their AI on-demand shared transport service.
Right, filling in transportation gaps. And then there's Mikolog, which is an AI-powered system that uses vehicle data to help with road maintenance.
But the truly unexpected part of Aisin's future is this aggressive push into non-auto innovation. They're targeting, what, a 10% share of total revenue eventually?
Yeah, and this is where it gets really interesting. How do you pivot that kind of heavy industry engineering capability into completely new markets?
Well, take YY System, a communication support app.
It's an incredible example of repurposed IP. It visualizes speech, environmental sounds, and it offers real-time translation for over 20 languages.
Wow.
It's been critically acclaimed, winning major design awards. And they're deploying it specifically for big international events like the Osaka Kansai Expo in 2025.
And then there's Hydrate. I have to ask about this. The same company making electric axles is making ultrafine water particles from air humidity for the beauty and medical fields.
I know, it sounds unbelievable, but it just shows you how deep their material science and precision engineering expertise really runs. It's an internal investment in diversification, proving their core talent can solve problems well beyond a car's chassis.
All of this aggressive growth in R&D requires an immense amount of capital. So let's talk about their financial foundation and their commitment to shareholders.
They've kept a remarkably stable dividend policy. It's held steady at a 170 per share, and they target a payout ratio of about 30%. They know they need to keep shareholder confidence while they fund this big pivot.
But the material financial lever here, the real story, is the balance sheet reform. It's all about boosting ROIC, return on invested capital, and freeing up cash.
Right. They're doing a radical spring cleaning of the corporate attic. Management has set these ambitious targets, compress $100 billion or more in operating assets.
Which means selling off old factories, divesting non-core stuff.
Exactly. And at the same time, reduce their huge portfolio of policy-held shares by another $100 billion or more, all by the end of 2025.
That is capital recycling on a massive scale. It's how they generate the funds internally to finance that 65% growth CapEx target without taking on a ton of new debt.
And their actions show they're serious. The total shareholder return ratio hit 121% in 2024, which shows they're actively using buybacks to lower their cost of capital and boost returns while shrinking that asset base.
So if we look at Aisin's trajectory, the short-term performance really relies on them managing that global mix of BEV and HEV demand and, riding those weak yen tailwinds.
But the long-term success of this whole pivot, it really hinges on the speed of two internal factors. The speed of that R&D shift into eAxles and braking systems, and the efficiency of that massive asset compression program.
They've identified the growth areas, the eAxle validated by BMW, the braking systems that save car makers a fortune, these surprising new mobility solutions.
And they know their legacy cash cow, the automatic transmissions and hybrids, has to bridge the funding gap.
But this raises the ultimate question, doesn't it, for you, the listener? You see the immense capital required for that aggressive 65% growth CapEx target.
So the question is this: can Aisin execute its ambitious asset compression targets fast enough and efficiently enough to fully finance its future without compromising its long-term commitment to that stable dividend policy? The speed of execution on that balance sheet reform, that is the critical variable that will determine their success.
That's Aisin, a deep dive into strategic transformation, technological agility, and the brutal arithmetic of corporate capital allocation. Thank you for joining us.